Hey everyone, welcome back to my channel. So, the Fed has raised interest rates to 5.5%. Wow, wow, wow. I mean, we all expected it to happen. It took a lot longer than I thought it would because of the pause, but interest rates have risen once again. This time, because of the pause, it gave a lot more businesses a little bit more time to kind of prepare for the increase. Before, they were getting slammed with increased rates and they didn't really have enough time to prepare, not enough time to maneuver. So they had to cut their workforce significantly and quickly because how were they going to keep up in a market that is simply, drastically changing? So instead of growing, instead of looking toward growth, they decided we're going to cut the fat now so that we're slim, we're mobile, and we're able to shake and move with the economy. Make sure you leave a like, comment, and subscribe right now. It really does help the channel grow as we get into this topic today. So, everybody knows that I used to love the stock market. In fact, I'm still a big investor in the stock market. I keep a good chunk of my money in stocks, and I do want my portfolio to be at least 30% stocks by the time I'm done with everything that I'm doing. But right now, I am heavily into real estate in terms of my assets, in terms of my equity as well, and every single month that continues to grow with principal and paying down debts as well. So with that being said, of course, everybody wants to know about the housing market and why it is so sticky. Well, the housing market will remain sticky because there is not enough people who are going to want to sell. There's not enough people who are going to want to risk what they have, which is that interest rate that you cannot get anywhere else. It's priceless. 92% of people have less than a 6% interest rate. There is no way that with a good credit score, you're going to opt in to a 7% interest rate on a 30-year fix. And it just doesn't make any sense right now. So imagine having a bad credit score and you're having to take out an 8.5% interest rate due to the fact that the Fed has raised rates so much. And it's being said that they're going to keep rates that high for at least 9 months after they're done raising rates. So I do anticipate at least one more rate hike before the end of the year. And then in 2024, they're going to keep rates high for the foreseeable future until maybe right around December of 2024. When they start to drop rates, I do expect people to start selling their homes who wanted to leave but didn't due to the fact that interest rates were high. New builds will have completely stopped by mid 2024 because anybody who is still building new construction are probably getting rid of that last bit of inventory, and they're putting a pause until interest rates start to go down a little bit more. So that's what I'm going to see happening. I'm going to see a lot less new builds hitting the market in 2024. At the tail end of 2024. So you're going to see, for the rest of this year, you're going to see the most amount of new builds that can be done being done. And then for the first half of 2024, whatever is left in the new builds that we're still getting done, that will be completed. And then by the end of 2024, there's no more new builds. So there's still going to be a scarcity in the market. And we're going to see a lag where people are still not able to really buy homes. And so I do expect housing to be scarce and continue to be scarce. There was a lot of people who moved in with their parents because they couldn't afford the new rents. A lot of people who just couldn't afford to rent whatsoever, and so they had to move in with family members. Because of that, when they do look to rent, when they do look to leave the nest, it is going to be increasingly difficult because rents will continue to go up as well, along with the fact that there are no new houses being built. So, with the interest rates being high, you're going to have to look at other factors in order to determine whether or not we're in a good place. those factors are going to be, are people losing their jobs? If people are losing their jobs, that's going to force them to sell. And unfortunately, that would essentially be getting rid of the American dream, because there are going to be people who lose their homes due to lack of work, due to not being able to sustain that mortgage. And even with unemployment, even with having a year to kind of recoup and try to regain that paycheck, that salary that they were making, a lot of people, 60% of people live paycheck to paycheck. So even 1 month of lost checks can lead to them spiraling down into a rabbit hole that is going to be hard to get out of. And then there's going to have to be negotiations with banks, negotiations with lenders, and different things just to continue to keep your home. So can you imagine if you miss out on maybe 3 months? At that point, it's good riddance. There's no way you're going to catch up, and you have little value in the home, so you might look to rent instead. And that's what will happen to very few people, but it will happen nonetheless. I don't expect I do expect a lot of people to get back on their mortgages, but it'll only be by 1 or maybe 2 months. I don't see a lot of people falling back 3 months unless they're really not caring enough to work hard in order to get that paid off. But what I really see happening in order to get the economy back in under control, I don't believe the Fed is going to hit their target of 2% inflation rates. I do believe that they're going to have to be satisfied with about 3.5%, and that's as far as they'll probably get to. And why I say that is because you're going to see food costs go down, especially when people are not able to pay for it. And then everybody's eating beans and rice and nobody's eating out. You're going to see restaurants start to cut back on labor because there's not going to be as many people looking for fast food unless it's really, really cheap. You're going to see a lot of cheap advertisements for food, dollar menu food type stuff. Just because of the market that we're in, they're going to be advertising the cheaper options, and that's going to get more people in the door who can afford to do that. You're going to see a lot of restrictions in certain things. Appliances, places like Best Buy, places like Target, places like Amazon, they're going to not have as much as they were making during the pandemic years when everybody was having excess money to spend. So they're going to have less money to put towards these things. Of course, these companies will still figure out a way to maneuver through the market, but it won't be as vibrant as before. There won't be as much overtime. There won't be too much of anything, honestly. And then with Christmas rolling around, we're going to see a lot of people lose that savings that they once had. Going into January is going to be tough for everyone. And then, of course, with tax returns, they'll have a small boost in the economy. But by May and June of 2024, I definitely foresee all the savings that we were able to gather in 2022 will be wiped away completely. By May of 2024, all the savings that we have been able to save since 2022 will be wiped away completely. For those who are spending aggressively, finally going out on those vacations and doing whatever it is that they wanted to do, all of that will be wiped away by 2022. But if you're investing, if you're doing the right things, if you're saving aggressively, if you're maintaining your job, if you're maintaining productivity, you will be just fine. So we're going to have to look at other indicators to why people lose their homes or to why cost goes down. And that's going to be lack of jobs. That's going to be unemployment kicking in. That's going to be food prices having to come down. That's going to be labor cutbacks. And when people cut back on their labor force, you're going to get nicer greeters, you're going to have nicer servers, you're going to have nicer restaurant staff, but at the same time, you're also going to have people who are not being paid as much, and those who are going out to eat having to tip a little bit more in order to sustain the lifestyle that they need to live, which is just a lifestyle of necessity at this point, because that's what it's going to come to. And so those who are eating out will be the ones that are financially able to do so. And because of that, waiters who are kind will expect that those people are able to actually finance their lifestyle because they're not getting paid enough to finance their own lifestyle. With that being said, you're going to see a lot of people taking on part-time jobs as well, in the wake of, you know, or unforeseen job loss, and you'll just have to pivot. You'll just have to move and shake with the economy. We're all going through this. If you're a millennial, you're going through this for the first time. But for those who were old enough to go through the 2008 cycle, you understand how this goes. You understand how this shakes out, and you understood how depressing it was. Now, obviously, this is a bit different in the fact that people actually had to qualify for the loans that they got. However, if you're no longer needed, like what Google did with some of their workers, now that will lead to something completely different, right? It may not be you who is at fault, but you may have over leveraged yourself, not thinking that you were as disposable as you were. And if you listen to my last video about everyone being disposable, then you would have kind of gotten the gist of that conversation. So again, make sure you leave a like, comment, and subscribe. What do you think is going to happen with these rate hikes that is going on? How long do you think it's going to take for things to start balancing out? And where do you think inflation is actually going to end up? Let me know in the comment section down below. I really do appreciate you all, and I'll see you on the next one. Peace.